These two trades were brutal, not because I lost twice, but because zooming out one time frame would have saved me. And that's a mistake I think every beginner trader makes at some point. My name is Bai. I'm documenting my journey towards consistent profitability using market structure, supply demand, and price action analysis. Let's jump into the chart and check out these two trades. I've turned back the clock and jumped to the 15-minute to observe market structure. You can see that our internal structure is bearish. We have a swing high and have created a swing low by breaking structure to this previous low. We've since started retracing back, and as I start my day, the only real area of interest for me to look for any shorts is this buy to sell candle here, which also sits above this 15-minute fair value gap, a strong characteristic of a viable order block. And so I'm waiting for price to mitigate this key point of interest before looking at any shorts. We can see that a few minutes later, we get a shallow mitigation of the zone. And so this is enough for me to check out the 1 minute to see if my entry confirmation has presented itself. Here on the 1 minute, we can see that buyers have created a high and sellers have stepped in to overrun this demand zone here and have created a fair value gap while pushing price down. To me, this is a clear signal that sellers are in control, and so I can look for an entry. For the purposes of this trade, I targeted this last buy to sell candle sitting right above the fair value gap as my entry. Stops go above the high, and I'm going to target a 3R trade here. We'll play price out to see what happens. So while initially price moves away from me, it does retrace back around 9:30 open and gradually kind of moves into my entry and even gives a reaction that sellers may step in at this order block. However, it's not enough and buyers end up stopping me out. So at this point, I'm careful to continue observing price since we haven't created a change of character on the 15-minute. We're still technically bearish. And so I want to see what price gives us to see if there's a second entry I can take. And perhaps sellers needed more liquidity here before initiating the price down. A few minutes later, we can see that price liquidates the strong high of this bearish leg. That's enough for me to check out the 1 minute to see if I have my entry signal. Here on the 1 minute, we can see something similar to what we just observed. Buyers have created a swing high here by taking these highs here, and buyers have stepped in to start challenging this key level here where demand initiated. If I place a line to denote where those buyers stepped in, we want to see sellers close below this level. If we advance price forward, we see that aggressive move similar to the first time around again, right here with the indication of the fair value gap. And so once again, I'm going to place my entries in a place that made logical sense in order to capture a prospective move down. For me, it's at the bottom of this fair value gap, which also sits above this key liquidity right here. Stops go above the high, and I'll again target a 3R risk to return. We'll play price out again to see what happens. We can see that price tags me in and even gives a bearish move as expected. However, since we don't close below any of these significant lows on the 1 minute, we can't move our stops to break even just yet according to my rules. And as we play price out further, we see that we hit stop loss once again. Now, if we zoom out to the 15-minute, this is where we see our learning for today. We can see that price has eventually closed above the swing high, telling us that we are now seeing a change of character in the 15-minute internal to the bullish side. The learning is that if we were to have zoomed out a little bit, we can see that our 15-minute external range is actually bullish. We can see that we have a swing low and a swing high up here. And so our external 15-minute is bullish. And we know that all time frames are fractal. And so as the external is bullish, what we were observing initially was the internal retracement down. And if we run a Fibonacci retracement tool on the swing high to the swing low, we can see that price actually was entering our golden area of the Fibonacci tool during our New York session, which tells us that there's a strong chance that price could reverse back to align with the external 15-minute structure. And looking back, that's exactly what happened. we are now bullish on the internal, which is in alignment with the external. And so if I had seen and observed and acknowledged that initially, I may have been able to save myself at least one of these losing trades. Good setups matter, but context matters more. And sometimes the most important thing I can do before entering a trade is to simply zoom out and see if there's a higher time frame narrative playing out. I'm not a guru. I'm just someone working towards consistent profitability using market structure, supply demand, and price action analysis. If this breakdown helped you see the charts differently, then subscribe and let's sharpen our edge together. If you want to see another trade breakdown, check out this video right here, and I'll see you there.